I can't see why a portfolio manager in the US shouldn't be getting rid of their nominal treasury bonds and taking tips. If inflation comes in at more than 2.5% on average over the course of the next decade, then that will turn out to be a smart move.
Welcome back to Breakout with Breaking Views, sponsored by PGIM. I'm Peter Thal Larsen, the global editor of Breaking Views in London's Canary Wharf. And I'm joined by Edward Chancellor, who is beaming in today from Manhattan, New York. Eddie, good to see you.
See you too.
So today we're talking about the issue that's giving many investors sleepless nights, how to protect their portfolios against inflation. Eddie, you've studied this in some detail with your usual historical sort of perspective and written a column going through most of the options. We'll talk about those in a minute, but before we discuss the possible solutions, just remind us why inflation is such a threat to existing portfolios.
Obviously, inflation is not good for fixed income securities like long-dated bonds because it erodes the value of those nominal obligations over time. But also, as we've seen this year, as inflation picks up, interest rates rise and the yields on the bond yields rise. So what we saw in the 1970s was the culmination of three decades decline in bond returns, at the end of which US treasuries were known as certificates of guaranteed confiscation. Equities, stocks, claims on real assets, companies, with buildings, factories, and so on. So in principle, they should provide you with inflation protection. However, they too suffer from inflation, in part because their earnings become more volatile because the economic conditions are uncertain, but also the earnings yield on companies, which is the inverse of the price earnings ratio, tends to rise with bond yields. So they stocks and shares, stocks and bonds tend to go down together in times of inflation. We saw that in the 1970s, and we've seen it this year. The other thing from just a technical portfolio construction angle is that over the last 25 years, I think we may have discussed this before, the traditional 60-40 portfolio, 60% equities, 40% bonds, has benefited from the fact that bonds and stocks and bonds were moving in differently over short periods, so that if the stock market went down, your bond portfolio would rise, largely in fact because the markets were anticipating Fed rate cuts whenever the stock market went down. But that changes at times of inflation, and then you get bonds and equities are positively correlated, which means they both go down together. So you don't get that insurance angle. We saw that in the 1970s, and the performance of the 60-40 portfolio in the 1970s, where it lost 50% of its value in the first half of the 70s in real terms. Now this year, the 60-40 portfolio, which has been generating these roughly 10% average annual return for the last decade, so staggeringly good investment, is actually down more than 20% in the US. So I'm saying that we need to find a different type of portfolio going forward.
Yeah. So people need something else, and you then go through some of the sort of the traditional sort of hedges. I mean, let's take them quickly one by one. I mean, I guess starting probably with gold, which is sort of classically seen as the inflation hedge, doesn't really seem to be working so well at the moment.
In the 1970s, gold went up 1,400%. So, but you have to bear in mind that the gold price was very cheap, having it been fixed under the Bretton Woods system. So it came from a very cheap level. Trouble with gold in the 70s is that it actually was very highly volatile. So sometimes, it formed bubbles and then busts and then ended in a bubble. Today, gold is down year to date in dollar terms about 10%. So people are thinking it's not such a good inflation hedge. However, against other currencies like our beloved sterling, gold is actually up 10%, up against the yen, up against the euro. So if you're a foreign investor, then gold doesn't look too bad this year. In fact, actually, I think its relative weakness in dollar terms today is really a sign of the general relative strength. If you see gold as a currency, it's at the sort of upper ranking or upper to middle rankings of the various currencies performing against dollar. So it's not too bad. But I also say, some, as you probably know, some investors won't touch gold with a barge pole. They say impossible to value and yields no income. And so I think you have your gold bugs, and I think there is an argument for having gold nowadays, but you can't. It's more of an argument from the heart than the head.
And then there's the other traditional argument is for real estate, because that's the ultimate real asset, and that should rise in line with inflation. But you're not so convinced about that.
Yeah, and you can see it this year that housing markets around the world are keeling over as interest rates rise, and I cite the U.S. Real estate investment trust being down nearly 20% in the first 6 months of the year. And the problem is that, as we all know, when interest rates are very low, how real estate prices went up and leverage levels around the world increased, and now we're working through that. So that, I think, is more of a headwind to real estate than the benefit that real estate will get from being a real asset. Now, I mean, it may, over the course of the cycle, that will play out, but it's just, I don't think it's a good time, obviously, to get into it.
So you do have a solution to this problem. So tell us what it is.
I was reading some books on inflation hedging in the 1970s, and either they came up with these sort of ludicrous allocations towards gold, 40% of the portfolio, and then one of the writers said there is no reliable inflation hedge, and it was sort of true at the time. They're all, I've done quite a lot of work on this in the past, and they're all very volatile and unreliable. But we do now have inflation-protected bonds. You have linkers in the UK and TIPS in the US, which were introduced in '97, and they too have performed very badly this year. We've discussed the linkers crash, but TIPS were also down around 10% or more than 10%. And the question is that a sign they're not providing inflation protection? And I say no. It was a sign that they were extremely overvalued at the start of the year. TIPS had a negative real yield of 1%, and these linkers that we discussed had negative real yields of minus 2.5%. Now, your TIP is back yielding 1.6%. And the question is, and that's real, that's with an inflation protection. And I'm saying that 1.6% is roughly in line with UK productivity growth during the last decade, during the era of secular stagnation. And I think that's a reasonable proxy for fair value. So I don't think TIPS are outstanding value. Having said that, I think the portfolios now, I can't see why a portfolio manager in the US shouldn't be getting rid of their nominal treasury bonds, which are currently yielding minus 4%, and in real terms, and taking TIPS. If inflation comes in at more than 2.5% on average over the course of the next decade, then that will turn out to be a smart move.
And as you say in the sort of payoff, that's also something that might allow an investor to sleep a bit more soundly at night, knowing that at least they protected against that possibility. Any Sorry, go ahead.
Because in inflationary times, portfolios we're seeing this year become a lot more volatile than we're used to.
Exactly. Eddie, this is fascinating as ever. We'll come back at some point and revisit your recommendations. But for now, thank you very much, and talk to you again soon.